are going to explain the money management strategies for Forex trading. Here I am going to explain the 360 money management strategy, which we can use in any type of account. Strategy 360. Let's discuss one of the best money management methods. If you have a strategy having 50% or more accuracy, we can use this money management strategy to ensure consistent profit. What is Money Management Strategy 360? Retail Forex traders do Forex trading without consistency. With proper money management, we can ensure consistent profit. Usually, if a trader loses one trade, they will skip the strategy and choose another strategy. Strategy 360 is the method of splitting the risk of a day into different percentages to achieve consistent profit. The account size or balance doesn't matter. It all depends on how much risk you would like to take. If you are a person who likes to risk $100, this is the maximum risk we are going to use in 360 strategy. $100 we are going to split into 1, 2, 3, 4 and 5 sets. The maximum loss will be $100. Which we are going to use for the particular day. So even if you have an account with a $1,000 balance, if you are choosing to risk $100, then you only lose $100, even if all the risk set failed. Here we are going to split the risk of the day in the different percentages. The account size or balance does not matter, it is all about how much risk you would like to take. The requirements to do this strategy. A strategy with 60 to 70% accuracy. The accuracy rate will help us to maintain proper risk and do quality trades. If your strategy does not have 60 to 70% accuracy, your trading does not work well. Proper target and stop loss. Strict stop loss and target will help you to maintain great discipline in trading to ensure consistent profit. What are strict stop loss and target? Before starting the trade, you should set your stop loss and target and fix the perfect quantity for doing the trade. Don't change your stop loss while running the trades, or don't exit before it hit the target. What are proper targets and stop loss? If a trader wants to maintain great discipline in trading, to ensure consistent profit, he can set a risk-reward ratio of at least 1:1. Rules to follow while using this method. Focus on one strategy. If you're using the moving average, then use the moving average only for all entries. If you're using stochastic, just use stochastic only. Only use one strategy. Don't change strategy if one set fails. Follow all the steps. Keep strict discipline. Step 1. If the price hit the target, continue with the risk set 1. Step 2. If the price hit the stop loss, follow the risk set 2 for the next entry. While the price hit the target, use set 1 for the next entry. Whenever the price hit the stop loss, use the next step lot or step. If one step hit the target, just come back to the first step. How does it work? For example, Trader John. He decided to use the maximum risk of $100 in a day. Risk sets are here. We have 5 sets. If he fails 5 times only, he will lose $100. So here we are going to use 3%. Then 6%. Then 12%. In 4th set, we are going to use 24%. In 5th set, we are going to use 48%. Even if any of the sets hit the target, he can come back to the profit or his balance will be positive. 50% accuracy signal result. One trade is successful and another fails. Even if the situation is like that, it has positive momentum in balance or equity. If having 50% accuracy, by using this method the trader can successfully achieve a $140 or 40% profit. This is the result we are having. What if a trader has 70% accuracy? So, with 70% accuracy, even out of 10 trades 7 will be successful and 3 will be fail. That is 70% accuracy. So we can assume in 30 trades 9 trades will fail and 21 will be successful. Here the price is going in a nice momentum, then the price is falling down because the 1, 2, 3 trade failed. Then one trade is hitting the target. The balance is coming back to positive. After 30 trades, there will be 9 trades that fail and 21 successful, and we can have a consistent result. How to use the risk? For example, Euro-USD currency pair. A signal having 25 pips stop loss and 25 pips target. The maximum risk allowed is 3%. $3 for $100 maximum risk. Risk/stop loss to get the lot size. 3 divided by 250 is equal to 0.012, the total quantity which you can able to enter for a signal. How to use the risk in the second set? If the stop loss is the same, a signal having 25 pips stop loss and 25 pips target. The maximum risk allowed is 6%. $6 for $100 maximum risk. Size equals risk/stop loss. We have $6. So, $6/250 or 25 pips. 0.024, the total quantity which you can able to enter for a signal. How to use set 2 if having a different stop loss? A signal having 40 pips stop loss and 40 pips target. The maximum risk is 6%. $6 for $100. The lot size is risk/stop loss pips. 6/400. 0.015 is the maximum quantity allowed to use. The third set that had the same stop loss as set 1. A signal having 25 pips stop loss and 25 pips target. The maximum risk allowed is 12% $100. Lot size equals risk/stop loss pips. 12% 250. 0.048, the total quantity which you can able to enter for a signal. We should be very careful with one condition. Stop loss may be different in different signals. The quantity should change depending on the stop loss. This is a very important thing while we are using this strategy. Where we can use it? Any time frames. Any strategies and indicators. Forex, crypto, and shares. Let's check the examples for strategy 360. Here we need 50% accuracy or more. Here we can see 50% accuracy and 70% accuracy. In 50% accuracy, we have $42 profit in 30 trades. And with 70% accuracy, we have $60 profit in 30 trades. It is very important how much we are planning to risk. If we are using $300, the risk amount will be used like this: $9, $18, $36, $72, and $142. If your capital is $500, and the risk amount also changes accordingly, has to change the risk values to $15, $30, $60, $120, and $240 depending on the risk percentages. 3%, 6%, 12%, 24%, and 48%. We need a strategy in which we can give a profit of 1:1, 1:1.5, or 1:2. Let's set the price as $100 and discuss for $100 risk. Let's check the chart. Here we have the chart of gold with 30 minutes time frame. We are using the stochastic strategy. I will explain very well about the strategy in the next video. You can use any strategy which has an accuracy level of more than 50% and a 1:1 risk-reward ratio. If the line moves above overbought level, 80, and comes below 80, we need to enter for a sell trade. If the line moves below the oversold level, 20, and comes above 20, we need to enter for a buy trade. We are entering the sell here with a risk-reward ratio of 1:1. It is hitting our target. We only risking 3% here. We have 3% of $100 is $3 profit too. Let's check in the next signal. It's coming in oversold and going up. We are entering by trade with a 1:1 risk-reward ratio. Price is hitting our target, so again $3 profit. We should write as 3%, but we are just writing as $3. Because here we are using a $100 risk. Here the price comes to the bottom. Then we are expecting a bullish trend from the bottom. The important thing is we need to wait for a green candle, while the price hit the bottom. Here got a green candle having a signal here, at the bottom just going for the buy. Setting stops and targets with a 1:1 risk-reward ratio. as we did before. The trade is getting so long because of low volume and did not hitting our targets or stop loss. So, we just need to wait. Here we got a setup. Here the price is not hitting the stop loss. So, we just hold it. The stochastic oscillator is reaching the overbought level and it shows a sell signal from the top. Also, the first trade still waiting for the result. Here we are using risk set 1 for the sell entry. The reason is the first trade not giving any result. The price is moving down and hitting the target of the second trade and the stop loss of the first trade. First, it hit our target and got $3, then it hit the stop loss of the first trade, so we need to use risk set 2 for the next setup. We got first entry $3, second entry $3, and the third trade we got pending entry and later hit the stop, and fourth entry hit the target and get $3. The fourth entry hit the target first, then the third entry hit stop, so for the next entry we need to use $6 or 6%. Let's calculate, $103. Then $106. Again, let's calculate $109. Then again it hit the stop and it became $106 again. Let's enter it into the sheet of Excel. Here let's copy and paste the same calculation. And the right and enter the price. And check how the price reacts. How the strategies work. In the first trade, we got $3. Second trade we got $3. Third trade we got $3. In the fourth trade, we failed. So the next trade we need to use is $6. 6% because the last trade is negative. So, we need to use step 2. We got a buy signal from stochastic oversold and got $6. The price already hit the target. And we got a 1:1 profit of 6% or $6. We are writing here just add $6. So let us check for the next signal. Let's continue. The market is overbought and let's look for sell entry. And it hit the target and got $3. The market is overbought again and let's look for a sell entry. And it hit the target and got $3. Let's enter it into the sheet. $6, $3, $3, so we are entering $6, $3, $3. Adjust the color to green because it is profit. Then calculate the total. One, two, three, four, 5, 6, 7. 7 signals are here. We are getting $18 profit in 7 signals. The one thing we need is if you fail in one step, you just need to use the next risk step. It is impossible to have crystal clear accuracy in Forex trading. Let's check again. Buy signal with a small stop loss. We need to adjust the quantity enough to risk 3%. Price is hitting the target. Here we got 2 signals hit the target and 1 trade hit stop loss. The next entry will be risk set 2, which is 6% here. The price is not made 1:1 and it hit stop loss. For the next signal have to use risk set 3, which is 12% here. The price hit the stop loss, so we need to use risk set 4 for the next entry, which is 24%. In backtesting, we can't be sure about news hours or low volume market hours. Here we got a buy signal with 30 pips, stop loss, and we should adjust the quantity depending on the stop loss. The price hit the target and give a 24% profit or $24 profit. Let's enter it into the sheet. -$3, -$6, -$12. 3 continuous losses and finally, $24. Change the color to red. Then let's calculate the total. After the loss and the profit, the net balance is $21. Here 118 become 121 after 3 failed trades and 1 successful trade. Now, this is the method we can use. In lower time frames like 5 minutes, having 5 signals per day. And if you want to make consistent profit every day, even if 3 or 4 trades failed, if 1 trade hit the target, you can come back to overall profit. The trader's life cycle. Like this, we learn, plan, trade, earn. Consistent. If you lose your consistency, then again learn, plan, trade. There is no success in the first trial. Let's learn and earn together.